Welcome to Money on Tap. Money on Tap, your personal finance headquarters, where we bring out the professionals' experience and some fun in what we call three-dimensional investing, utilizing insurance, brokerage, and fee-based planning. That's what we do on this show. We look at all sides of the issues, and we bring a fully independent planning perspective to the table.
Welcome. You are listening to Money on Tap. My name is Seth Krussman, joined here once again by Ben Brayshaw and Dan Mickelin. You can reach us at 855-226-8551 or info@yourmoneyontap.com. How are you guys doing today?
I'm doing great. I'm doing really good. How about you, Dan?
I am doing excellent as well. Glad to have Ben back. I mean, we've got the whole band back
Sure
together
you're glad,
for the
Dan?
first time.
You sure you're glad?
I am glad.
You heard that, folks. You heard that, folks. Now I get to bust his chops.
It's tough sitting in the producer's chair. You know, there's a lot going on over there. I'm just, I'm new to that.
Folks, today we are going to be talking about put up or check up. It is one of those things that, frankly, very few people do in taking a look at their year and their year end. There's so much focus at this time of year on family and getting together and the holidays that some pretty important stuff can get overlooked in your finances. And we're here to bring you into the fold of what you can do to make sure that you're just checking some boxes of what's really important for you and your financial planning. That's what we do here at Money on Tap. We are three-dimensional investors. We take a look at all sides of the investment world as independent financial planners with Brayshaw Financial Group. We get to look at basically everything that's on the market and put you in the middle of that and make sure that we're putting plans together that include everything that's available. And more important than that, what's most important to you and your financial journey. So with that, Ben is just dying to get in here.
Yeah, no, I think about what we do in the three-dimensional planning and so forth, and no time is more important for that skill set than the end of the year. I mean, to be able to look at the entire picture and really kind of bring the end of the year financially into a solid close. I mean, that is probably the best opportunity people have, and to be able to look at all sides of that picture, that's a big piece.
And I think this year in particular is an important year to do that. I mean, coming off of the turbulence of the market we've had, the potential of a kind of looming recession out there, everything going on in our world politically, we're going to dive into some of that here in a minute too. I mean, this is one of those times where, you know, you do need to carve out that day to spend with your books and set aside the kind of holiday cheer and all those other things just to make sure you're not going in blindly into a new year and a new set of circumstances.
Well said. This is one of those years. This is one of those years where you might be able to really captivate your financial picture in a much healthier form than maybe you've experienced, just with what the market's done, and be able to transition that into something that's just a little bit better off for you long run. And I think you can turn every glass half empty into something half full. So
opportunity awaits.
Wow, I was about to jump in a couple of minutes ago, but you guys said pretty much everything I wanted to say. And opportunity was the word that really comes to front of mind. And that is a tough place for some people to come to in terms of their perspective right now. You might be looking at the future and thinking, well, maybe not everything's going to be that bright. Well, guess what? We're going to shed some light on what you might be able to take a look at differently. I think there's going to be a ton of takeaways for everybody that is an investor or is looking forward to retirement and wanting to make that a part of their story. With that, it is time for us to have some fun. We're going to get into money in the news.
And first up here, we've got an article coming to us from Yahoo Finance from Brian Sozzi. Midterm elections, what 60 years of stock market data says. And we've talked about this a couple times in the shows recently, where there's a lot of strong historical precedent around the fact that in the times following midterm elections, regardless of which way they go, regardless of any changing of governmental structure in terms of what parties are favored and what chambers of Congress, the market has responded well. And in particular, this year there's some certain expectations around that, primarily being that the expectation that Republicans would take further control and really be able to stymie Biden's agenda, which seems to not favor the economy in really any measurable way. So the hope is that a couple more years of gridlock, would create really an environment where, the markets, our economy, the people leading our businesses can have a little bit of faith in that moving forward, they're not going to face any political hurdles, in order just to do business.
Yeah, still, Dan, you and I were chatting. I'm just surprised it wasn't the red wave that, after all that's happened in we're probably going right back to $5 or $6 a barrel, gallon gas. It's just not the message that needed to be sent to, everybody from Biden to the entire Congress to the Fed chair. People do not want this. This is just there's a lot of pain there financially, and there's a lot of initiatives that are creating additional financial pain. One of the other money in the news items we're going to talk about, and there's just a lot of, I think, misconceptions of what's a need versus a want or a desire, and that's just the breakdown is pretty horrendous. But when you look at the 60 years of market data, it doesn't necessarily paint a bad picture when you look at a midterm election. Go ahead.
No, it paints a decent picture, actually, a really good one. And going back down to the 1960s, so this goes back into the Kennedy era, there was only 3 times where following the midterm election between November and year end that the market was down. And the furthest down it was, of those 3, was 1.1%. So kind of a small drop off. And if you look at the market, though, in every segment going from November to April and then November following to the next November, so 6-month and year-long breakdowns, the market has been positive in every single instance.
Every single instance.
Every
and
one.
we talked about this a few shows ago, and I think when you start looking at it, it's like, hey, do I want to invest for the 6-month average and make 15% on average, or do I want to invest for the 12-month and average a little more than 1% better at 16%?
Take either one, just invest. That's the message there.
Yeah.
Yeah. If you are like so many investors out there that right now are, hanging on to the CDs or have just cash at the bank and wondering what to do, maybe you've rolled out of the stock market a while ago. And right now, this is just there's just too much volatility and uncertainty for you in the market. Then this is not your day, because it's still the market at the end of the day. But in terms of what somebody that does invest in the market and is participating in and understanding that the laws of large numbers and history is a good indicator for us of where we might want to take positions. This is some hard numbers to walk away from and say, no, this is not what I'm not going to invest in, right? To take a piece or a step in and participate just doesn't make sense for somebody that's in the market or doing what, has money on the side and looking for the opportunity to step in.
I think now is like a really decent opportunity, I think, to amplify some of these statistics that we're looking at historically. The market's just been horrendously down, over the last year, basically, 11 months. And, so there's potentially some opportunities with some good discerning thought about, really finding some value in the market, finding some places where you think there's some really long-term opportunity, separate from the fact that this 12-month history is like really playing in our favor. Because this isn't like, it's 100% of the time that in the next 6 months since Kennedy, after a midterm election, 6 months, that the market's up. 100% of the time it's up 12 months. The 12-month story is really great, but the 6-month story is phenomenal. And the market's up 5% in the last month. So that's interesting. We're going to see some fluctuations. I think if we saw a bigger red wave, we would have seen a lot of market upside post-election. But that remains to still be seen.
Yeah, I think it's rare we get these 100% trends, right? So
we like 100% trends.
Yeah, that's easy to work with. But of course, no guarantee going forward that that'll continue to be the case. But there's a lot of precedent that suggests it's a good time.
Investing. Wow. When are we ever at a time in our lives where we have more opportunity to participate in something that's pretty amazing? Like we've got the historic elections happening, midterm elections happening, and some of the data surrounding that. I look forward to seeing what happens and being able to have some more shows around just this window of time. Maybe you're one of these people out there that has an annual salary increase. We've got some interesting information on what's coming or what's been happening around the salary increases, and this is by pay scale. Thank you very much for this data. But there's, how much is an average salary increase is pretty interesting to take a look at. And over the last decade, an average salary increase has hovered around 3 to 5%. And there's several different kinds of salary increases that were given to us through, the article, which I was not really well informed about, believe it or not. Some of those equity raises, which were, stuff that is out there and information out there, but I haven't really paid a whole lot of attention to. I've been mostly looking at the COLA increase, which is, the cost of living increase of, trying to keep up with inflation that, companies have been participating in. But some of the data out there says that they're actually kind of falling off. And that was kind of a bit of a surprise.
Yeah, I think the idea that, the various pay raise conversation and trying to maintain people to the office has a lot of different dynamics that haven't existed in a long time. And there's, as employers ourselves, we're constantly looking for strong employees to keep them cared for, to make sure that they're provided for in that process. And, we want to reward that. It's interesting that the data has shown that people who have merit increases over this time period have not only stayed more, but they've actually had an average increase of 3.6% in their pay alone, separate from like general performers of 2.5% and then low performers of 0.6. So, there's a significant merit-based employment practice that seems to be taking a little bit of a stage here because, honestly, as employers, we're dealing with inflation as well. As an employee, you see things going on, you got employers that we have building bills, we've got rent and, insurance costs and taxes, and where, you pay half of the taxes of every employee. There's just lots of different things that are just draining from a company. And so as inflation grows and taxes grow, it becomes sometimes just overwhelming. We all know that, right? But from an employee's perspective, it's like, well, I've got to pay my bills at home, and I need more money because it's more expensive too. So the merit space has really kind of come into play because honestly, if a company's doing better, they can afford more, and it kind of balances out the give and take there a little bit. And I think that's why it's getting a little bit of a stage.
Yeah, the cost of living increase that a lot of people are used to and basically expect in their paycheck. That 3 to 5% annual increase. With inflation, at least according to the Labor Bureau here, running at 5.3%, if you're getting anything less than kind of the top end of that, 5% average annual raise, you're going to find yourself with less purchasing power next year. You're not keeping pace with inflation in terms of the salary increases. So, the other types of raises that are out there, so we've got cost of living raises, we've got merit increases, which we've just talked about, equity raises and promotions, and then ultimately there's the opportunity to leave and find a new job. If your scheduled increase isn't going to allow you to keep up with inflation and it's difficult to make ends meet as it was in 2022, you really better think about, 2023 and going forward, while the job market remains pretty hot, are you in the right place? Do you need to focus in on the job you have a little bit more, and try and pursue some of those merit increases, or, potentially look elsewhere?
And I think you're right, Dan. If you're not being able to meet your cost of living needs, I would tell you that engage your employer on a merit increase because, that would be something that would say, hey, I'm willing to participate in this fight for business, and you're much more likely to receive a positive response in general, even just knowing a lot of different employers out there.
Yeah, I mean, this isn't coming from the article. This is coming from real life.
Yeah.
Here at Brayshaw Financial. I mean, if it's just difficult to find new people and replace people in this job market. So if you feel like there's an opportunity for you to contribute more where you're presently at, in exchange for more compensation, that sounds like a conversation worth having.
Okay.
Yeah, I can't think of anybody that's in a situation that they want to retain talent and they've worked really hard to develop it. And that person coming to them saying, hey, I would like to make more money. What do I need to do to improve to get to that level? That is usually a welcome conversation.
Yeah.
Folks, we have one more, and we've saved the best for last here. I think this is going to be a lot of fun. Is the in California, there was on the ballot, and this was ballot measure 10, if I'm not mistaken here, but it was a ballot to tax the rich to fund electric cars, and one of the most interesting things about this, I thought, was that Governor Newsom was stepping up and saying, yeah, no, this is not a good idea for you guys to do.
The idea that I would ever agree with Governor Newsom is just absolutely, completely.
That's truly the funniest part of this article.
That's the funniest part of it.
That's why we had to have it here. In the proposition that's out there, was to impose a 1.75% tax on people who make $2 million or more in the state of California. So it seems like a relatively small percentage against what has to be a comparatively small community of people, right? 2 million plus. So we're not talking, the 400,000 that some of the kind of federal guidelines have come up with.
I think this is a flat tax for everybody who makes more than 2 million. I mean, that's what this is, right? It's a flat tax. I think this should be an open ballot conversation, and everyone who votes yes should pay the 1.75.
Regardless of income?
Regardless of income. It's still flat tax. I mean, you make $100.
Wow, that's a volunteer. That's an interesting. I've never heard that before. A voluntary tax. Like you vote here and you're saying, yes, I would like to participate and contribute this percentage.
Right.
And people can go ahead and do that.
So if you vote yes and you make less than 2 million, you pay.
You pay the 1.75
as well. So you make $100, give $1.75.
It was interesting.
I wonder how that vote would go.
Oh yeah, I know, right? So no, if you vote
no yeses.
If you vote no and you make under 2 million, you don't pay. But you vote yes and you make under 2 million, you pay with the people who make 2 million.
Yeah, I don't see that vote going very well.
I don't think it's going very well either. But that's socialism for you.
But what also was interesting here in the article, and probably part of the reason that Newsom opposes, is that this proposition that made it to the ballot, and it was 95% funded by Lyft, the rideshare company. So this whole notion, wasn't even something that came out of, whoever the tax revenue specialists are in California saying, oh, we get an opportunity to grab some dough here. This came literally from the ride-sharing companies because they don't provide cars, right? And by 2035, there's going to be no gas-powered cars in the state of California. You won't be able to buy a new one.
Right.
So they see themselves as saying, hey, listen, we need to find a way to amplify these electric car sales so that we have a usable fleet of drivers, 10 years from now.
Right.
And so they've funded entirely, 95%, this campaign around getting this question put into the ballot. So it's kind of interesting how that all works, right?
Well, the fact that all the Lyft drivers and the Uber drivers are considered, and they fought in court, Lyft has and Uber, right, in California, that they were independent contractors. Like they spent lots of money in court that they were independent contractors. The fact that they're funding this, I wonder if this created any potential liability that maybe they're not independent contractors if they're going to be required.
If they're going to buy the car and hand it to you, then that sounds like an employee to me.
Yeah, you're darn right it does. Or if they even subsidize anything directly or indirectly.
Yeah.
I mean, there's a lot of, but this is California for you. I mean, this is why people are moving out of there left and right.
And then that's what closed the article out too, which was interesting. Both parties kicking in a perspective of saying, and they're probably pointing to Elon Musk, so we can get our Musk mention in for today. Like you have all these mega companies and entrepreneurs leaving over the tax structure. So we don't want to impose this further burden on kind of the high-end earners. So they don't want to create the exodus, right? They don't hasten the exodus of high income people by imposing this additional tax. But the pushback is that, in the last 5 years, they have 4 times as many people qualifying, in terms of earning more than $2 million per year. So apparently, regardless of what they do tax-wise there, people want to come to the coast and they make a lot of money.
That's exactly right. There's nothing like Los Angeles. Yeah. Folks, that is going to do it for us in Money in the News. I do have to make a quick amendment there. It was Prop 30, not 10, that was being voted on there. So anybody doing some fact-checking, appreciate you. Yeah, we are going to be talking about put up or check up. It is time for your annual checkup, and there's some stuff that you just want to make sure that you are on track for before the new year. And now's the time to get going on that. We're going to be right back. Don't go anywhere. You're listening to Money on Tap. You can reach us at 855-226-8551 or info@yourmoneyontap.com.
Do you have an annuity? Do you understand exactly how it works and when to use it? The likelihood is that you don't, or maybe you bought it a while ago because at the time it sounded like a good idea. But will it accomplish your goals? We are here to help you. Contact us about a free annuity review and learn what your annuity does, how it works, and how it can best help you with your retirement goals. It's absolutely free to you, and if there's a better way for you to accomplish your goals, this is a great way for you to learn about those opportunities too. Take the time to get educated, get empowered, make your retirement a success. Call us at 855-226-8551 or info@yourmoneyontap.com.
You can reach us at 855-226-8551 or email us at info@yourmoneyontap.com. And now, more Money on Tap with Ben, Seth, and Dan.
Welcome back. You're listening to Money on Tap. You can reach us at 855-226-8551 or info@yourmoneyontap.com. We are talking about put up or catch up. It's that time of the year. We do some year-end planning, and before January 1, it's really good to take a look and see what some of the opportunities are. That's the key word here today, is these are opportunities that we are going to discover and uncover with you today.
And one of the things that's most important to probably start with and check first as you're moving through your financial year-end checklist is your retirement plans. It's what we focus on here conversationally, and you hear us reference this stuff a lot. But make sure that if you are contributing and, we're rounding out to year-end, you've contributed up to the max, maybe you find yourself or to the match rather, maybe you find yourself in a position where there's still some room underneath the maximum contribution limits and you have some income on its way through that, you can get closer to those limits or get right up to them if you can. And this year for 401k, it was $20,500 for those of us under 50. And if you're 50 and over, you have a catch-up provision that allows for another $6,500, so a total of $27,000. And for certain companies, if they allow it, there's some backdoor non-deductible opportunities where you can get in up to another $40,000.
Yeah, I mean, that gets you to those, kind of those max numbers. I mean, when it comes to 401k planning, there's a lot of conversation around this. I mean, there's because you have Roth 401ks and you have kind of that traditional 401k pre-tax where Roth is post-tax, meaning that if you're contributing to the Roth, you're not going to get a deduction from that standpoint. So, the conversation about retirement planning has a lot to do about what you think of taxes today and what you think of them, 20, 30, 40, maybe 10 years from now, whenever your retirement is going to come into existence. And one of the problems is that we're not looking at a target date. I think it's funny when you talk about target date funds, the mutual funds and these 401k plans, when you think about a target date, not all your money is designed to retire on the same day you are. You can't think of it as like, hey, this is the target date for my investment. So therefore, when I turn 65 or 66 or 70 years old, all my money needs to be available. Theoretically, if you were really to be diversified, and I hate target date funds, and I would never put a penny of my own money in them. So take that, listeners, for what I'm saying. But if I were to diversify and only have the option to invest in target date funds, I would put money in all sorts of target date funds, dated all the way out till I was 90 years old or 100 years old, because that's when I'm going to need those dollars. And people don't see it that way. People don't talk about it that way. So when you're looking at retirement in general and the idea of putting money away in a pre-tax 401k versus post-tax, the conversation needs to be, what will be the tax rate on this dollar when I take it out? Will it be higher or lower? Now, then there's a tertiary conversation about what is the match I'm getting from the company. So the first thing is hey, I'm putting in 4%. My company's matching 4%. You absolutely should put in that 4%, whether it's pre or post tax. Just get the money in the plan, because that's free money. We always promote free money. I don't think anyone goes against free money. It's all good. After that, every dollar you make into that retirement plan really has to be that conscious decision of, how is this going to impact my future in the most positive way possible?
Yeah, I love what you're saying there. And actually, the strategy that you just built out there was one that I don't think I've ever seen anybody apply. The target date funds kind of layering or laddering, kind of what Ben just described as almost like a bond ladder, where there was different buckets of money and their expiration on those dates of those bonds as they come to, fruition, roll into the next set or become liquid and there's cash available. So, well done. That was interesting.
Well, thanks, Seth. Appreciate your encouragement there. I'm going to...
It's a good strategy for the one you said you would never employ.
I'm going to leave the studio now. No, but the idea, I was actually talking to somebody last night, and they were telling me, hey, listen, I really need help. I'm in target date fund. And I was saying, these things are atrociously expensive. There's more lawsuits out there for those things than almost anything else. Invariably, you don't even know how well diversified inside your scope of risk you really are each and every day. There's just so much unknown with these things. But the concept of the plan for people who are so commonly using these target date funds is just breaking down the thinking that, well, I'm retiring in 2040, so that's the fund I should be in. But all your money's not paying for retirement in 2040. And that's the misnomer. If we can get our audience, if you're listening to us, which you are today, understand that all of your money has to work and just be available the dollars you need that day on that day. And the rest of the money still has to remain at work. So if you're retiring your dollars on the day of retirement, you're basically setting yourself up for failure.
Yeah. There's also the expectation around these, the fund is going to accomplish what I need it to accomplish. Like if that 2040 target date is out there and I start using that, somehow there's a misbelief that this fund is going to get me where I need to be in order to retire. And that would be a false statement, because what that fund is designed to do, it may be completely opposite of what you need to have happen inside of your investments to get you to where you can retire.
And something else to take a look at in the retirement account realm is, if for whatever reason you've had a year where your income was a little bit down, or if looking forward you're just of the opinion like we are that tax rates are going to be just skyrocketing going forward, that this is the time to look at those Roth conversion opportunities, right? You may be able to contribute to one. Perhaps your income limits or your income is in excess of the limits, which for 2022 was $144,000 for an individual, $214,000 for a couple filing jointly. But some of those positions you have very likely taken a hit this year in the market, and perhaps your income was up or down. But if your expectation is of future higher tax rates, this is the time to take a look at those kind of underwater positions and consider some conversions there.
Yeah, I love this. I love this idea. And if people aren't evaluating their current tax situation when it comes to Roth conversions and the opportunity around that, and a great example is, I think the idea of Apple stock being almost $200 a share this year and dropping to in the 140s, and it's like that's a massive loss. And could more losses be coming for Apple? It could, but if you're doing year-end planning, what better way to say, hey, here's a company I'm probably in for the next 10, 15, 20, 40 years maybe. Maybe you're going to own Apple till you're 90 or 100 years old and pass it on to your children. What better way to pass it on to your kids to know that, hey, I'll own Apple today, I'll convert it at $145 or $150 a share and let it go back to $200, and there's no taxable gain on that move of almost 25%.
Yeah, so the kind of the note here is if you have a specific position, whether it's a fund or a stock that has really gotten hammered, but you're a true believer and you're going to have this thing, it's a great opportunity to take the tax hit now, push it onto the income side, and then let it appreciate going forward and never be taxed on it again. And you don't need to convert your entire IRA to Roth. Or that's the part of the lesson here, is that you can break it apart and convert specific pieces or percentages of a larger account, so that you're managing your tax situation, right? You don't have to push the whole IRA into a massive tax event today. So be selective with that, and that's something we can help you take a look at.
Yeah, this is something that has a real conversation on a lot of different levels. I was talking to one person who they actually lost their job about 3 or 4 months into the year, and they had enough money in the bank, and they were just not touching their retirement plan. And I said to them, hey, you make under the number. We should start converting as much as we can up to the income. You actually have an opportunity here where your income's going to be lower, and they're intentionally like, hey, listen, I'm taking this time off. I'm just going to, and they're starting their new job in the new year. And it was really a great opportunity for them to kind of talk through, hey, this is going to cost you money. Because when you do a Roth conversion, they don't withhold the taxes, from the asset you're converting. You have to pay this out of pocket. You got to come up with those tax dollars yourself. So that's what makes this not like everyone wants to do it, right? So, but our government printed $10 trillion. They've, increased the debt by over 50%, and it's a painful, painful story. And if you think taxes are going down over the next 20 years, I would tell you that I would disagree.
And moving on from the retirement accounts is our taxable accounts, right? So these also, require a little maintenance, and you got to get some eyes on them. This is an opportunity here on that side of the coin. If you do have those stocks or funds or investments that have taken a big hit, they call it loss harvesting, and we talked about this in our last couple of shows, where you can sell those positions, realize the loss, and then be able to move up to $3,000 of that to reduce your income for tax purposes.
Yeah, this is good because there's a lot of people who have invested in oil and gas companies where they've made money this year. There's lots of places where people have made money, or they're carrying over a gain, or whatever the story is from something else, a sale of a piece of real estate, right? And the idea that you could say, hey, I've got these losses over here in my portfolio, and you may like the company that you've lost money in, but it just might make your tax situation better in the course of that story. And taking advantage of the loss harvesting is key. And there's a strategy behind it. There's a strategy of when you sell it and take it. Like, I would encourage people to do that before year end, because there's other people who are going to do it right before year end. And you might see some stocks really drop in kind of an unsubstantiated way, much deeper or bigger loss in a stock because people are taking losses everywhere in a year like today to offset gains. I mean, there's been so much gain in real estate. I mean, people have sold huge properties for big money. So they might go through their portfolio and just say, sell everything you possibly have with a loss. And I've had people call me with that conversation in stocks.
I mean, considering the amount of money that's invested in mutual funds, and this is the season, or we've just come through the season where a lot of the mutual fund managers are cutting their losses on these and trying to harvest those internal losses, that can push the market. And we've seen a market that's come down considerably So as we come towards the year end, that's all the time that you have to do this is, end of year, to actualize those losses and be able to take those, in through the tax code and lower your taxes. I think one of the challenges that as we just had a conversation around, midterm elections and historically what's happened as far as the market, doing quite well over that 6 month to a year period after the election is, do you take the loss? Do you just go ahead and sell, take the loss and put it into cash and hold it there? Or what's the next place that you can put it so that you're not missing out on, other opportunities within the market? And so that's what you can't do is, I think, Dan described very well, is you can't just sell it and then 2 days later put it back into the same investment, or something that's so similar or like that they'll nix that and say that's not a strategy you can use. You have to go ahead and put that money to work into something that isn't the same or similar, and that can be a bit of a challenge if you're not really aware and understanding what that looks like. Give us a call. You can reach us at 855-226-8551 or info@yourmoneyontap.com. A lot of what we're talking about are some of these rules of the road for the adjustments that you really need to be taking advantage of. If you're listening to Money on Tap, you can reach us at 855-226-8551 or info@yourmoneyontap.com. We're talking about put up or check up. The time of year for you to get your financial checkup done is now. There's a lot under the hood here. It really depends on, you can have even just a very, very simple plan needs to have an evaluation. You need to take a look at that. There's a lot of different factors inside of just a simple plan for you to consider what's important. And in the larger planning side of things, and this comes to, actually, believe it or not, this is a simple and very small plan consideration as well as the estate plan, because guess what? Everybody does die, and that's where the estate needs to have some direction. At least in our experience, that is what works the best for the people that are going to receive or be a part of that transition of life for you.
Yeah, and that starts in kind of the simplest thing we can do, to make sure that intents are preserved and you're prepared for the unexpected, or at least your finances are, is a beneficiary review. As simple as that. Run through your accounts, your IRAs, your life insurance policies, any of those assets that allow for the specific designation of where that asset goes on your demise. Run through those things, make sure it's still the way you want it to be.
Estate planning is, obviously a key component to the whole process. And what's great about estate planning is it really defines the goals going backwards. It helps you see the end of the road conversation of like, this is what I want the end to look like. So therefore, hey, listen, this is the trajectory we're aiming at. That's a really key component. And what I usually tell people is, let's make a date. Let's make a goal of when you want to get certain estate planning things done. We got a few months left here almost a few months left in the year. Make your New Year's resolution that you're going to get this done either next year or by the end of this year. Make it your goal to actually say, this is what I want to get done. I want to get my will updated, or I want to get a will. I want to get my trust done. We have an in-house counsel. We have an attorney here, Mike Henry, great guy, easy to work with, super competent, super capable, been in the legal world for many, many, many years. And it couldn't be easier to work with somebody and get that done in a very simple fashion, even if you're just trying to close some doors and protect kids, if that's what your situation is, or protect a special needs child, or you're worried about probate or any of those types of things that are popping through your mind. It doesn't have to be super expensive. It doesn't have to be overwhelming, but we have lots of relationships with lots of attorneys, and we can work with your attorney inside your investments and so forth. So there's lots of different opportunities in the estate planning piece. But the most important part of estate planning is really understanding, again, taxation inside giving to your heirs, your children, however that's going to flow. How's your IRA going to be handled? Are you prepared for the taxes they're going to have to pay? Are they going to have an undue burden in some way that you have set up things that are not the most efficient, that they're going to unfortunately lose a large portion of your hard-earned money? I can't tell you the number of people we've sat down with and said, if you do it this way, you're going to lose another 20% of your money just in taxation. If we swing it over here, it's like a free 20% return if you do it this way. People don't understand the transition of dollars and how that can be so adversely impacted by just how someone actually receives the money and in what form, fashion, or investment style they're in.
Yeah, and with different assets, speaking specifically to children and grandchildren, dependent upon how things are going for them financially, how you have it in mind for these things to move on may not be the best way for them to receive it collectively. One child may be doing significantly better than another, and so to preserve the ultimate and the most value of your estate you can, how those things get dispersed into who can be impacted by how they're doing in life.
Now, let me give you an example for our listeners here. Let's say you have one child who's a neurosurgeon making $1 million a year, and you have $500,000 in your IRA retirement plan, and you got a nice home, worth about $500,000, right? And then you have another son who is working hard. He's a mechanic. He makes $30,000-$40,000 a year, and you say to yourself, huge disparity here, but I'm going to give to my children equally. And we've had clients that said, they're both happy, they're both doing great, whatever. Well, you don't want to give the neurosurgeon the IRA inheritance because he's at the highest tax bracket in our country. And he's going to pay, 46% of that money or more, depending on which state he's in, to the IRS. So $500,000 is going to turn into $250,000. Meanwhile, he's, you've got your son who's, a mechanic making $30,000 a year. And it's almost irrelevant which one he gets, right? And he can spread out his IRA, the IRA that he inherits from you over time, so that he might pay no more than 10% in taxes. So meanwhile, you might look at it and say, all right, well, to break this out equally and to pass on the most money, we might focus more of the IRA inheritance on the son who makes less money and is in a lower tax bracket, and pay and give the house, which is not going to have a taxable event, or the majority of that, to the neurosurgeon, so that they actually get the net same amount of money. And that could be a really very simple conversation of just understanding how the tax flow is. Now, there's a lot more detail, a lot more breadth to that conversation around all sorts of types of investments and all the different pieces that work, whether you own annuities or investments or stocks or IRAs or however the money's housed. There could be a lot of different things you're dealing with. And you might have more than 2 kids. So, breaking that out in the way that you want to create equality, if that's a goal of yours, could be something that's
equal on the way out isn't necessarily equal on the way in. Right? So understanding those implications and just having that conversation to make sure that the most of your hard-earned work and financial assets you've accumulated over life stay with your family and don't get lost into the tax picture.
Yeah, absolutely.
So one of the things that you were touching on there was the executor. And that's one of the most common places I find people, have good intention. And what does that mean? What's an executor? It's somebody that really cares for your estate after you pass on. And if you do not decide to choose one, well, the courts will choose one for you. And usually it's going to be somebody that's, the next of kin that's willing to do the job. But avoiding a snafu here, this is what's so common for families is, the executor just doesn't make the decisions the way that the rest of the family thinks that it should go, or another person in the family thinks it should go. So having a third party in there that's willing to do the job is really critical. So many families just get broken up in the process of distributing assets and taking care of the estate after passing. And the other thing I'd say to look out for if you are in this market looking for an executor is, most big banks will provide these services, these fiduciary services, but what they'll also do is they won't handle an estate that's below a certain asset level. And B, if they are going to handle that estate, they will require you to use their services or their investment services. It's a way for them to accumulate more assets and kind of pressure that whole system into, you handing over the assets at that point. We work with some independents that do a phenomenal job of doing the stewardship of your assets post-death. And so if this is something that you need as a resource, guess what? We're a great place for you to go ahead, give a call, find out who's available in your area. That's the last thing I would say around this is make sure that somebody is in your area, okay? Because state to state, things change a lot. You can reach us at 855-226-8551 or info@yourmoneyontap.com. We are going to take a quick break. You're listening to Money on Tap. We'll be right back.
Hey folks, Seth Krussman, Brayshaw Financial Group is our company, and we bring to you Money on Tap. I say we, that's Ben and I. We have a lot of fun doing this show. And one of the things that we love about doing Money on Tap is that our goal for you to have access to the financial planning world. How do we think? What are we doing? What are we talking about? Raising the bar of your financial education. It's so critical. And that's what we're doing here. The other side of this is as well, we're financial planners. If you are looking to work with a financial planner, if you want to have that playbook for you to understand the important things right now and how you're going to get to your goals or how you're going to retire successfully, that's what we're doing as well. If you have $250,000 of investable assets, give us a call. It's free to you, and it is worth your time to pick up that phone and give us a call and discover what complete wealth management looks like. Ben and I are excited about the opportunity to partner with you and give you that financial plan that's going to make the next step so much better understood and get you where you need to go.
We appreciate you listening to Money on Tap with Ben, Seth, and Dan. You can contact us at 855-226-8551 or email us at info@yourmoneyontap.com. And now, more of this week's program.
Welcome back. You're listening to Money on Tap. You can reach us at 855-226-8551 or info@yourmoneyontap.com. Folks, we don't have a whole lot of time left in the show, but we've got a lot of stuff that we want to make sure that we pack in. So I am going to go ahead and just say this. Rebalance. All right. This kind of comes back to the whole portfolio where we started in our checklist here. You have assets that have been put into a portfolio. You had a design around that portfolio. It was, call it 50% equity, which is, stock market and stocks, and then 50% bond. So what happens over the course of, if you were to take a look at 10 years of investing, it would look like basically the would no longer be a 50-50 portfolio. You'd have a 33% bonds and about a 67% stock. That is what happens with growth, right? The portfolio grows. As equities are going to grow faster than those bonds are going to grow, and it gets out of balance. And so what happens is you as an investor not rebalancing your portfolio on a regular, just call it once a year basis, you're going to have a very different experience than what you intended to have at the beginning. That market, when it drops, you're going to feel it more than you thought you should or wanted to or could tolerate within your risk. And that gets a lot of investors sidelined at one of the most critical points. They pull out of the market because it's not what they can deal with. And that's another part of the check-in is where are you at with your risk too? I mean, taking a look at how things have changed. Maybe it's been 5-10 years. You're closer to retirement. Maybe you just can't handle the risk that you used to. And your portfolio needs to be designed a little differently to keep you investing and moving forward.
All important things. And I'm probably more of a proponent of quarterly rebalance than I am annual. I think annual sometimes, the fact that you have those choices out there, or even semi-annual, the market shifts too often, too much, that, things go out of favor. And if you can get more money in those things that are out of favor at times, and start you're almost dollar cost averaging in if you do more rebalancing. So that's a really good point, Seth. I really like that a lot. And I think it's something that unfortunately it doesn't take place in a lot of people's 401ks. People don't even think about that stuff.
Yeah, if you just think about the major indexes, right? The S&P has fared pretty poorly this year. But when we're talking about kind of post-election run-up in the market, those are S&P stats we're looking at.
Right.
So your S&P holding is going to be down percentage-wise to your overall portfolio because it's taken a more significant hit than Dow did. But that means it's time to kind of reposition and get those things reallocated so that, if the goal is to ride this next 12 months and history repeats itself, you may not be positioned properly to take full advantage of it. So take a look at that.
Agreed. I think the last thing that I think would be really important to cover, and probably something for some of our philanthropic listeners to take into mind, is we do a lot of charitable giving work. We do a lot of charitable trust work, high deduction, tax incentive investing focused charitable giving. Those types of trusts are things that we do. We have attorneys that can write up the trust documents, and we can actually tier those into something that really brings your projected income into realm. And so if you're a listener and you understand what I'm talking about, saying, hey, my income's X and I really need it to be way down here at Y, charitable giving is something that you can do. And it's not just giving away to a charity. It's strategic giving. It might be giving in a way that creates income for the charity today, that might produce an asset for you or your family later on in life, or it could be giving to a charity in the future but creates income for you today. And those are different types of trust programs that we do. There's also, maximizing giving over certain years, where you can kind of front load your giving for the next 2, 3, 4, 5 years, and do that in this particular year, and then have that money doled out over the 5-year period to meet the charity's needs. That giving you the deduction today over something that you want to disperse over a period of time. All different mechanisms to really maximize your tax, moving pieces that happen, because lots of people have made a lot of money this year. For as much as the stock market might have been hit for a lot of our listeners, the world's been on a financial tear for a long, long time, and there's a lot of money out there.
Yeah, in the last couple of years, for people who are more moderate givers who aren't necessarily given a ton, but the standard deduction is raised fairly generously in these last few years. So, if you want to make sure that you maintain your philanthropic goals and you still make those contributions, but you want to make sure you're realizing the tax benefit that you're used to, there's some strategies and ways to do that, and we can help you accomplish that.
Folks, we have covered a lot of information for you here. And if you're listening to us on the radio, you can find us in the podcast world and go back and have a listen. Even better than that, reach out to us at info@yourmoneyontap.com or 855-226-8551 and connect with us and sit down and take a look and see where are you at. What is it that you've got under the hood right now, and how is this all coming together for you? And what are the opportunities that you have before the end of the year to capitalize and to really, who knows? You might be missing out on some tax gifts for you, believe it or not, that the system works both ways if you're paying attention and know how to do it. So we want to give you confidence. That's one of the things that every plan should have inside of it, is confidence for you to go forward, live your life, spend the time that you need to with your family this holiday season, and not have to think about or worry about what's going on with your investments and your plan. And so when we do this and we come together and we get this plan really, really working for you, guess what? You get to go boldly. Go boldly into 2023. That's our goal for you here at Brayshaw Financial Group, a Money on Tap, as we put this show together. And gosh, it has been a lot of fun. Thank you so much, you guys.
Yeah, thanks, Seth. I agree. We go boldly. We do this, step up to the plate right now, right before the end of the year. Lock your things in. Figure out what the best way is to move forward, and make this year and next year really, really, truly great.
I think that's a good way to wrap it up. Boldly into 23. I mean, all indications are that we should have a good year coming off of the heels of where we've been. So just make sure you put some thought into it and you take just the best advantage of that you can.
That's going to do it for us here at Money on Tap. We look forward to talking to you guys next week. Thanks for joining us.
The views expressed are not necessarily the opinion of this radio station and should not be construed directly or indirectly as an offer to buy or sell any securities mentioned herein. Investing is subject to risks, including loss of principal invested. No strategy, product, material, or tool mentioned can assure a profit nor protect against loss. Please note that individual situations can vary. Therefore, the information, products, materials, or tools mentioned should be relied upon when coordinated with individual professional advice. Past performance is not a guarantee of future results. This show may be subsidized in whole or in part by a product sponsor or issuer. Securities and advisory services offered through SagePoint Financial Incorporated, member FINRA SIPC, and a registered investment advisor. All other services offered through Brayshaw Financial Group LLC are independent of SagePoint Financial. SagePoint Financial and Brayshaw Financial Group do not provide tax or legal advice. Main office is located at 116 South River Road, Bedford, New Hampshire, 03110, and can be reached at toll-free 855-226-8551.